When buying a property, the general rule of thumb is that you should have a 20% deposit plus costs. Anything less than this may lead to lender's mortgage insurance, LMI, and higher interest rates. However, a 20% deposit is a significant amount of money, which can take years to save. Fortunately, there is an alternative, and that is to use a guarantor. A guarantor is someone who offers assets as security for your loan. Typically, it's a family member, often parents, and the security is usually their home, but some lenders also accept other assets like term deposits. The guarantee is generally the difference between your deposit and 20% of the property's value. For example, if you're purchasing a $700,000 house with a $70,000 deposit, your loan-to-value ratio is 90%. The guarantor would secure the additional 10%, which is $70,000. Once your LVR drops below 80%, the guarantor can be released from the loan. This requires an application to the lender. The LVR can reach 80% either by paying down the loan or through an increase in the property's value. As property prices are out of your control, it is recommended to aggressively pay down the loan until you reach the 80% LVR. The guarantor is taking risk on your behalf, so it's important to remove that risk as soon as possible. Before utilising a guarantor, it's important you understand what happens if you don't meet your loan obligations. If you default on your loan, the lender will first work with you to explore options, such as capitalising interest for a short-term issue. If an agreement can't be reached, the lender will then seek to sell your property to recover the debt. Should the sale of your home not fully repay the loan, the lender will turn to the guarantor for the shortfall. The guarantor can cover the shortfall up to the guarantee amount, but if they are unable to do so, the lender may sell the asset used as security. Any surplus from the sale would be returned to the guarantor. For the borrower, having a guarantor provides several advantages, including the following. Smaller deposit required. You can buy a property with a small, or sometimes no, deposit. Avoid lender's mortgage insurance. LMI can cost thousands, but with a guarantor, you can avoid this cost. Better interest rate. Lenders view you as a low risk, offering you more competitive interest rates. And no need for genuine savings. With an LVR in excess of 80%, lenders will require you to show savings held for at least 3 months or accrued over a 3-month period. With a guarantor, this requirement is waived. There are very little downsides to the borrower. The primary risk is that the guarantor can allow you to borrow more money, increasing your repayments and exposing you to interest rate fluctuations. You need to ensure that your cash flow can handle the repayments comfortably. Many of the risks with the guarantor lie with the person who is going guarantee, and they should carefully consider the following. Assets at risk. If the borrower defaults, the guarantor's assets used as security may be sold to cover the debt, and inability to sell the asset. Once an asset is used as security, it cannot be sold unless either a new asset is offered as collateral or the borrower pays LMI to release the guarantor. Utilising a guarantor can be a valuable financial strategy, particularly in phase 1 of wealth creation when you're establishing your financial foundation. However, beyond this stage, it is advisable to become self-sufficient. If you do use a guarantor, it's crucial to prioritise paying down your loan to release the guarantor as quickly as possible. This means cutting back on unnecessary luxuries. Additionally, ensuring you have adequate personal insurances is vital. This ensures that if you're unable to work due to accidental illness or injury, you can still meet your loan obligations. If you think having a guarantor is an appropriate strategy for you, we strongly recommend you speak with your financial advisor and mortgage broker. They can help assess the appropriateness for your particular situation. Please note, the information contained in this video is general in nature only and does not take into consideration your objectives, financial situation, or needs. As legislation is constantly changing, the accuracy of this information is only relevant as at the time of recording. Before relying on the information, you should check to see if the content is still relevant.